The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Good morning. You are listening to Money in the Morning with Mitch Goldberg. We so greatly appreciate you taking the time to join us. We're on 103.9 FM, exclusively LI News Radio. We thank you for tuning in. And just as an aside, we have at LI News Radio, we have a really good app. The app, check it out in the App Store, Google Play, wherever you download your apps. It's a really good app, and it's very easy. You just click the triangle, you listen to the radio, and you can take us wherever you go on the road, stream us through the Bluetooth in your car, and you'll have Long Island News with you wherever you go, and we appreciate that. Okay, let's begin the day with the pre-market. This is a little bit more of a rougher morning than we've seen lately. Dow futures down 275. S&P futures down 46. That's a little bit over 1%. Incidentally, the Dow futures are down, almost indicating an open of almost down 1%. And the NASDAQ futures are down 175 points. That definitely gets my attention, down 1.37%. Oil is basically hugging the flat line. The 10-year Treasury continues its march higher. We started the show yesterday at 3.7. Today it's in at 3.83%. So many interest rates are keyed off of the 10-year Treasury, in particular mortgage rates. So as you see the 10-year yield rise, mortgage rates are quick to follow. And the VIX is, nothing crazy. It's at 19.56. Just think of it this way. When we get above 20 is when we start to see a little worry creep into the market, and we get more volatility. Like today is orderly. Markets are expected to be down, but it's nothing so terrible that people are getting really nervous about. It's just, we could be off to a mildly down start to the day. That is really all that indicates. And by the way, as we all know, whatever the futures do in the morning is not it's not a guarantee of how the whole day is going to go. By the way, you can't invest into an index directly, but you could invest into a security that tracks or mimics an index, and you have lots of choices, which we could go over another time. So why are markets down today? The producer price index, the PPI, came in hot, up 0.7% versus expectations of 0.4%. And it's basically telling you that the economy remains a little too hot to handle for the Fed. It's telling you that, well, we were all thinking 2 quarter-point hikes are baked in for Fed rate hikes over the next 2 meetings. This is telling you that probably more rate hikes are in store. Maybe even a 0.5 point rate hike could be coming up. Bottom line is the Fed rate hikes, its tightening policy, has not had the intended effect on inflation as of yet. And we don't want to be in a position where you've got a Fed that has to get so aggressive that they have to jack up interest rates to levels higher than what anyone would forecast. The general consensus is the Fed gets the federal funds rate to about 5.25%. There's talk of 6% now. And although not a lot of people are saying 6%, it's starting to become more and more. And you'll take your clues from Fed governors when they speak. They start to telegraph what they want to do, what their intentions are. So they start talking and saying things like, well, inflation is running a little hotter than we expected, or the intended effect is taking longer, or we really think businesses and consumers are continuing to feel the pressure of inflation. And those are basically your hints that they're worried about it and they will continue to raise rates. So that's what that means. And raising rates is not something that's considered good for the stock market. higher rates are not necessarily going to be terrible for the market. It's not a death knell. People think, oh, that's it. It's all over. No, this is not a doomsday scenario. Okay. The market does worse when rates are actually, or better, depending on the directional move in rates. If rates could get to a point where the Federal Reserve freezes, we call that a pause, that wouldn't be terrible for stocks. That would be good for stocks. And when we thought we were getting to a pause a few weeks ago, stocks started to rally. Now that we're seeing the pauses further away, stocks have to reprice and go down ahead of that. And, I expect that little trend to continue. And when could it reverse? Well, we have to wait for the next unemployment figures to come out. We have to wait for the next CPI and PPI figures to come out, and lots of other data. So, we have weeks to go to really pick a positive direction. Now, I'm not saying you should make your financial decisions based on this. If you're a long-term investor, I would be surprised to see people, to see investors reacting to this like it means something. It's not really something that it's not something to base your financial future on. Other numbers that came out today, the first time unemployment claims came out at 194,000. The number was expected to be 200,000. That's a number that when it's lower is bullish on the economy. It means fewer than expected people are filing for first time unemployment claims. And last week was actually revised down a tiny bit by 1,000. So it just continues to show you that the labor market in real time is very, very strong. And all of these layoffs you're hearing about in the tech sector, it looks like these jobs are easily getting absorbed into the economy, and it hasn't spilled over to other areas of the market of the economy. The only outlier I could see is the Philly Fed survey of manufacturing said orders are taking longer to get and a slight deceleration in orders. Not a recession or anything, just a slight deceleration in new orders in manufacturing in the Philly region. But we have different regions, and they go up and down for different reasons. And I don't really go by the outliers. It's when you're looking at dozens of statistics and they're all pointing strong economy and one doesn't, you have to take that with a grain of salt and see what it's like and just monitor it, okay? It doesn't change the direction of anything. So that's what we are looking at today. Stocks making big moves today. Shake Shack up 9%. Same store sales were looking pretty good, up over 5% year over year. Virgin Galactic up 5% pre-market. Paramount Global Entertainment Company, slumping 6%, missed estimates in the top and bottom line. Who else would we know? Roku rallying 7% after reporting narrower than expected loss of $1.70 compared with a loss of $1.73. Revenues were slightly up higher. Just real quick about Roku. Airbnb the other day took off like a shot. A lot of these money-losing pandemic stocks, which were, they were hot for the pandemic. They took off because they helped you stay at home. Airbnb was popular because it gave you the ability to just go on vacation and have your own house and get away for a while, get away from the big city. And you don't have to share the space with other hotel guests. These stocks tanked, but they have definitely had a resurgence this year. I find that my own sense is it's a bounce, and I'm very weary of companies right now when interest rates are rising that aren't making money and that are what I consider richly valued. When a stock is up that doesn't make money, it's easy to say it's richly valued. So no surprise there. So that is what I see. I don't want people to chase these stocks. When I look at the big trend of airline transportation globally. Air India just put an order in for 500 new jets, which is a record ever, of which almost half is going to Airbus, a little bit more than half. I'm sorry, is going to Boeing, a little bit more than half is going to Airbus. But those are the kinds of companies and trends you want to look at in green energy. And the companies in the middle of this is Boeing and GE, as far as I can tell. And I want to look for good quality companies that can ride trends. Defense contractors. Boeing is also a defense contractor, like Lockheed Martin and other companies. Shopify is plunging more than 10% in pre-market. So a lot to talk about. Boston Beer down more than 11%. I guess the stock is going a little flat, but a boom. And Generac is up only about 1%, received an upgrade. You're listening to 103.9 FM LI News Radio. We talk about stocks, investing, the economy, and personal finance because we want you to become the best possible version of your financial self. To learn more about me, check out moneyinthemorning.info. Again, that's moneyinthemorning.info. I'm Mitch Goldberg, and if you want to take this conversation offline, certainly you are welcome to reach out to me. We'll be right back after these messages. To Money in the Morning with Mitch Goldberg. We so appreciate you taking the time to join us. We cover a lot here, which is one of the reasons why I jump right into the music. I really want to take advantage of every minute that we have together. And it's just so important. We have so many great things to talk about. And I want to reinforce that just because you see the pre-market down in the market, it doesn't mean you should get excited or nervous. And I'm not saying all of you are like that. I'm talking to a pretty big audience, so I want to make sure I include everybody. We are not going to remember what the Dow Jones or S&P futures did pre-market a year from today. We're not going to remember what it did today. The key is if I educate you on what's happening, why markets move, and you know more about it, number one, I'm hoping you'll make better investing decisions. Number two, when you make a decision, because it'll be based on more sound reasoning, you'll be less likely to make imprudent moves at stress points in the market, which could get you stressed. When the market skyrockets, people make the move of throwing more money into the market, and when the market tanks, people take money out. But I don't want people operating in the extremes of big ups, big downs. I want investors, I want all of you to be set and be confident that you did everything you could do with regard to your investments, your plans, the things you can control, so that when the market does hit its stress points, huge ups, huge downs, you know to expect those. They're factored into your plan. They're baked in the cake already. And you just go on about your day and say, I've got my secret edge here. I've got a plan. And that's really what the point of this is. And when you start to understand all of this, you start to realize it's interesting. I find it fascinating. Not everybody does, but it doesn't have to. It doesn't have to make you do something at the worst possible time. Okay? You know how it is. Making big decisions when we're stressed is not the best time to make decisions. We as humans, though, seem to be really good at doing that. So it's something that we all have to fight. This is what makes me a professional. I can fight it and I help walk people through it. And hopefully you get through it. And that's, if you get anything out of this show, if you get that out of this show, I am a very happy person. Really, I'm so happy. All right. So let's talk about what do we do with this information. This is IRA season. This is the season where you do your taxes and you decide, should you put money into an IRA? If you're already in a company 401k plan and you're not putting money into an IRA, it's still pretty much IRA season because there's usually a lot of money that goes into the stock market, some positive money flows. Quite often it does help lift the market a little bit. But regardless if you're putting money into an IRA or not, let's just consider this retirement account season. Okay? And this affects all of you. So when I said, you should have a plan or, investing, you should make decisions at market stress points, big ups and downs, it's because you have a risk tolerance. And your risk tolerance, is set by your time horizon. And it's not like we all have one time horizon. You have your time horizon for retirement. But even when you're in retirement, you have more time horizons. You are expected, most of us, if you're fortunate enough to have good health, you'll be in retirement for 20 plus years, many of you 30 plus years, and every day we're going to see people in retirement more and more for 40 plus years. So you still have a long time horizon even after you retire. It's just that you typically would have less money in risky assets, volatile assets like stocks, more money in more stable investments like cash, money market, savings accounts, CDs, treasuries, short-term bond funds, that sort of thing. They're more stable because when you need to take money out of these accounts, you don't want to get stuck in a horrible bear market just when you need money. Bear markets could last a long time. We've seen that before. And we don't want you running through all your money in much fewer years because you were invested too aggressively during a potential bear market. So we have to, even though it could be unlikely to have an extended, 5 to 10 year bear market, for many of you, if it does happen, it would be unacceptable. So that's why I am insistent on toning down your risk metrics as you get older, but not toning it down to zero because stocks are still considered a hedge against inflation. I know what you're thinking. Well, Mitch, stocks are down a lot now. What kind of hedge is that? Stocks do well over time, but over long periods of time. If you average out the good years and the bad years, you earn a decent return. But I don't know what year you're going to need your money. I don't know what year you're going to have an emergency. Neither do you, which is why we invest a certain way so that we could be prepared for anything that comes our way. And we have to compromise with our allocation between stocks, bonds, and cash. This is just, basic finance, basic investing 101. I think a lot of you know this, but a lot of you maybe need a reminder or didn't think of it as succinctly as I just said or as simply as I said. So it's IRA season, and you look at this season, whether if you're in a 401k and you're not contributing to an IRA or not, there's a couple of things you need to consider. If you are making an IRA contribution, is it going into an IRA, traditional IRA, or a Roth IRA? The difference is, traditional IRA, you get a tax deduction. So if you put $6,500 into it, you get a deduction. If you put $7,000, if you're over 50, $7,500, you get a catch up, but it's a deduction off of your gross income. So it's like saving, let's say, for example, $2,000 on your taxes. But a lot of people simply say to their accountant, I want to reduce my taxes. What could you do? And the accountant says, IRA, traditional IRA. But what I like to do is, well, when do you want to reduce your taxes? Do you want to reduce them now? Or do you want to reduce them 20 years from now? There's a huge difference because that money you're putting into your IRA will probably grow. 20 years, it could be worth triple or more what it's worth. So you could be paying taxes. When you take money out of an IRA, you pay taxes. So you could be paying taxes on a lot more money. If you're in a Roth IRA, you don't pay taxes on that money when you take it out down the road. But you could miss out on that, for example, $2,000 deduction today, that $2,000 tax savings. So you save $2,000 today or potentially save a lot more in the future. Now, some people feel a bird in the hand is worth more than two in the bush. I get that. That is what makes personal finance personal. It's up to you. It's your preference. And my job is just to let you know your choices, how they affect you down the road. My job is always to let you know how things could affect you 20 years down the road or more. That's what I want to do. I can't tell you how the stock market's going to affect you tomorrow. I don't even try. I do know that if we invest properly, we have a plan, it shouldn't affect you. But I want to know what comes up 10 years down the road. So you might be better off with a Roth IRA, and this is something you should speak with your accountant about. There are income limits. There are limits in terms of how much money an individual or filing jointly, how much you could make to put money into a Roth IRA. So these are the things that we talk about. Refocus your retirement plan. Now, if you haven't rebalanced your account or refocused your retirement, your 401k or your 403b or your SEP, you need to do that, because maybe there's just something in there that doesn't belong there anymore. Maybe you read about a hot ticket fund that was so great, but that was a long time ago, and the premise for buying it is no longer there. There's so many things to talk about. Here we are. The time is up already. Oh, my goodness. So if you want to take this conversation further on a one-on-one level, check me out, moneyinthemorning.info. I love hearing from you. It's actually the best part of what I do when I hear from the listeners. You're listening to 103.9 FM, LI News Radio, Money in the Morning with Mitch Goldberg. My partner, Bobby, will be filling in for me tomorrow morning. So please tune in. Give him some love. Cross your fingers. Wish him luck. He is excellent at what he does, and he's going to do a great job for you tomorrow. Thank you very much, guys. Have a great day.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member of FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.
The views